Last video, I promised you the invisible lines that price seems to respect again and again. Here they are. Look at this chart. Price climbs, hits this exact level and drops. Climbs again, hits it again, drops again. It's not a coincidence. It's not luck. There's an invisible ceiling sitting right there, and once you learn to see it, you'll notice it on almost every chart you look at. These invisible floors and ceilings are called support and resistance, and they're arguably the single most useful concept in all of chart reading. By the end of this video, you'll be able to spot them yourself, understand why they exist, and know what to watch for when price finally breaks through one. Let's get into it. Let's start with support. Support is a price level where a falling price tends to pause or reverse because enough buyers step in to overpower the sellers. Think of it like a floor. Price falls toward it, and instead of crashing through, it bounces. It rarely happens at one exact precise price. It's more like a zone. But the idea is simple. This is a level where demand has historically been strong enough to stop the fall. The more times price has bounced off a level without breaking through, the more traders notice it, and the stronger that support tends to become. Now flip it around. Resistance is the mirror image of support. It's a price level where a rising price tends to pause or reverse because enough sellers step in to overpower the buyers. Think of it as a ceiling. Price rises toward it, and instead of breaking through, it gets pushed back down. Same logic as before, the more times price has been rejected at that level, the more significant it becomes in traders' minds. So to summarize the two, support holds price up, resistance holds price down. Here's the question beginners always ask: why would price respect an invisible line at all? The answer comes down to collective memory and psychology. Traders remember where price reversed before. If a lot of people bought at a certain level and made money, they're often willing to buy there again if price returns. If a lot of people got burned selling at a level, they remember that too. There's also a simpler force at play: round numbers. Price levels ending in a long run of zeros act like magnets. Psychologically, humans round numbers up in their heads, and huge numbers of orders tend to cluster around them. And finally, previous swing highs and swing lows, the exact points where price has turned before, tend to be where large institutional orders sit, waiting. Put it all together and you get real, repeatable price levels, even though nobody drew them on the chart for you. Here's how to actually find these levels yourself. Look for a price point where the chart has reversed more than once. One touch could be a coincidence. 2 touches gets interesting. 3 or more, and you've very likely found a real level. For resistance, connect the swing highs, the peaks where price turned back down. For support, connect the swing lows, the troughs where price turned back up. And remember, it's a zone, not a laser-precise line. Price often pokes slightly above or below a level before reversing. Give it a little breathing room, rather than expecting a perfect bounce to the exact pip. Here's the concept that makes support and resistance genuinely powerful, not just descriptive. When a resistance level finally breaks, when price pushes through the ceiling with real conviction, that old resistance very often becomes the new support. The ceiling becomes the floor. And it works the other way too. Broken support often becomes new resistance. This is where your candlestick reading from the last video pays off. A strong, long-bodied candle that closes clearly beyond the level suggests real conviction, a genuine break. A candle that just barely wicks through the level and closes back inside is often a rejection, not a breakout, and the level is still holding. So how do traders actually use this? There are 2 main approaches. The first is trading the bounce, buying near support or selling near resistance, betting that the level holds one more time. The second is trading the breakout, entering once price convincingly pushes through a level, betting that the move continues. Both are valid, but both carry the same major risk: the false breakout, sometimes called a fakeout, where price pokes through a level just enough to trigger traders, then snaps straight back. This is exactly why we just talked about candles. Don't react to a single wick poking through a line. Wait for a close beyond the level, ideally with a strong-bodied candle, before you treat it as real. Let's lock this in. Support is a price floor where buyers tend to step in. Resistance is a price ceiling where sellers tend to step in. These levels exist because of trader psychology, round numbers, and memory of past price action. Look for multiple touches at a similar price. The more touches, the stronger the level. It's a zone, not a single exact price. Broken resistance often becomes new support, and broken support often becomes new resistance. Watch the candle at the level. A strong close through it suggests a real breakout. A bare wick suggests rejection. Two main approaches: trade the bounce or trade the breakout, but always wait for confirmation. You can now read a candle and spot the exact levels on a chart that matter most. Genuinely, that's enough to start looking at charts the way a trader does. In the next video, we're stepping away from chart theory for a moment and getting practical: how to choose a Forex broker, what actually matters when picking one, and what to avoid before you open any kind of account. If this video helped connect the dots, hit like. It genuinely helps this channel reach more beginners working through the series. And drop a comment below. Go find a support or resistance level on a chart right now. Which pair did you check, and what did you find? I'd love to see what you spot. See you in the next lesson.